Welcome back, everyone. Sean Stevens here again with Metroplex Mortgage Services and another USDA Loan Pro video quick tip. How can a USDA Debt Ratio Waiver increase your maximum sales price? What happens if your qualifying budget needs a little boost in order to qualify for a home that seems to be just out of reach? That is where a USDA Debt Ratio Waiver can help. And in today's video, we'll explain the factors needed in order to increase your USDA qualifying ability. And don't forget, we are known for keeping realtors and homebuyers updated through each step of the process, from pre-qualification to closing, along with one easy point of contact. As a starting point, your debt-to-income ratios are calculated by dividing your new mortgage payment against your monthly gross income, and also by dividing your total monthly debt payments by that same income. Now, the housing portion of your debt ratios are referred to as your PITI payment, and include monthly amounts for items such as your principal and interest, taxes, insurance, etc., while your total debt ratio consists of that housing expense plus additional monthly debt such as any auto loans, credit cards, or student loan payments. Also, USDA published guidelines allow 29% for housing and 41% for your total expenses, but expanded ratios of up to 32% for housing and 44% for total ratios are available, provided that the qualifying credit score of all applicants is 680 or greater, and one of the following compensating factors is identified on a purchase transaction. The proposed PITI payment is equal to or less than the applicant's current verified housing expense for the past 12 months, which can be verified through sources such as an eligible verification of rent, credit report, or 12 months of canceled checks, or by utilizing mortgage reserves, which are funds that are available after closing, and provide at least 3 months of PITI reserves can be verified from an eligible source. This can be used as a compensating factor, but remember, cash on hand is not eligible. And lastly, if all employed applicants have been continuously employed with their current primary employer for a minimum of 2 years, but this is not an eligible factor for applicants that are self-employed. Additionally, because debt ratio waivers are only applicable on manually underwritten loans, make sure your lender is able to work with USDA manual underwriting guidelines for those loans that do not receive a GUS accept. In summary, don't get pulled into the weeds on the details. Just understand that by having at least a 680 score and meeting one of the factors we discussed, this can provide for an immediate boost to your qualifying ability. But make sure you are working with a USDA approved lender that truly understands how to maximize the USDA qualifying guidelines. I want everyone to make it a great day, and I look forward to seeing you right here for the next tip of the week.